What happens if two of the most important trade routes on Earth shut down at the same time? Not just one, two. The Strait of Hormuz, the gateway for a huge share of the world's oil and LNG, and Bab el-Mandeb, the narrow artery linking the Red Sea, the Suez Canal, Europe, Asia, and the global supply chain. If both closed together, this would not be a normal market scare. It would be shipping would surge, insurance costs would explode, supply chains would tighten, and households around the world would start feeling it in places that matter most: at the gas pump, at the grocery store, in utility bills, in investment accounts, and in the monthly budget. This is Wired Wanderer, and this is what the world might look like if two choke points break at once. Most people never think about maritime choke points, but the global economy depends on them. The Strait of Hormuz sits between the Persian Gulf and the Gulf of Oman. It is one of the most important energy choke points on Earth. In 2025, around 20 million barrels per day of crude oil and oil products transited Hormuz, and that represented around a quarter of the world's seaborne oil trade. It also carried more than 110 billion cubic meters of LNG in 2025, with no practical alternative route for most of those exports. Then there is Bab el-Mandeb, the southern gate to the Red Sea. This choke point links the Indian Ocean and Gulf of Aden to the Red Sea and the Suez Canal. And Suez has historically handled around 12% to 15% of global trade. When Red Sea attacks intensified in 2024, Suez traffic dropped sharply, and global shipping demand and freight rates jumped. So one strait is a giant energy valve, the other is a giant trade valve. Close both at once, and you hit oil, gas, shipping, manufacturing, food logistics, and financial confidence all together. That's why this scenario matters. If both straits closed suddenly, the first reaction would be confusion, fear, and repricing. Tankers would stop. Container lines would suspend routes. Naval forces would go on immediate alert. Insurance markets would reprice war risk aggressively, and financial markets would begin doing what they always do in a crisis. They would try to figure out how bad this could get before the physical shortage even fully arrives. The immediate market story would be simple: energy risk up, shipping risk up, inflation risk up, growth expectations down. The physical closure of Hormuz would threaten a huge volume of oil and LNG that simply cannot be rerouted easily. The IEA notes bypass capacity is limited mainly to some Saudi and UAE pipelines, leaving a large share of Gulf exports exposed. At the same time, closure of Bab el-Mandeb would force traffic away from the Red Sea and Suez and around the Cape of Good Hope, adding time, fuel cost, crew cost, congestion risk, and emissions cost. UNCTAD already documented that even partial Red Sea disruption caused major rerouting and significantly higher shipping demand and costs. That means within days, markets would understand this is not just a military story. It is a cost of living story. This is where the global economy gets punched in the face. Hormuz matters because so much oil goes through it, and because the alternatives are limited. Asia takes most of that oil, but a major disruption would hit the entire world through price, not just through geography. If Hormuz closes, Saudi, Iraqi, Kuwaiti, Qatari, UAE, Bahraini, and Iranian export flows get hit. Global oil traders reprice supply risk instantly. countries start bidding against one another for available cargoes. Strategic reserves come into the conversation, and central banks start worrying that inflation is about to return hard. This isn't just gasoline. Oil affects trucking, agriculture, aviation, shipping, plastics, fertilizers, manufacturing, packaging, and power generation in some markets. When oil spikes, the cost structure of the economy changes. If the closure lasts only days, markets may panic and then partially calm. If it lasts weeks, the shock starts becoming real. If it lasts months, then you're no longer discussing volatility. You're discussing recession risk. The IEA has already had to coordinate emergency stock responses during the current Middle East conflict because Hormuz disruptions materially impeded oil flows. A lot of people think only about oil. That's a mistake. Hormuz also matters for LNG. In 2025, over 110 BCM of LNG transited the strait, and there are effectively no alternative maritime routes for most of it. The IEA says those volumes represented almost 1/5 of global LNG trade. That means a prolonged Hormuz closure could hit industrial gas users, power generation, heating markets, European import flexibility, Asian LNG buyers. Even countries not directly dependent on Gulf LNG would feel the effects because global spot prices would rise. And when natural gas prices rise, electricity prices can follow. So households may feel this not just in gasoline, but in heating bills, electricity bills, higher prices for goods produced using gas-intensive industry. That's when the crisis moves from headlines into kitchens and living rooms. Now let's hit the other half of the problem. Bab el-Mandeb is the gateway into the Red Sea and toward the Suez Canal. If that route closes, ships moving between Asia and Europe cannot just shrug and continue. They must reroute around southern Africa. That is a much longer voyage. UNCTAD found that previous Red Sea disruption already caused tonnage through the Gulf of Aden and Suez to fall sharply, while capacity rerouted around the Cape of Good Hope surged. It also found that higher freight rates from these disruptions could feed into consumer inflation, especially in vulnerable import-dependent economies. This matters because long shipping routes mean higher bunker fuel costs, more ships needed to deliver the same amount of cargo, higher insurance costs, longer delivery times, more port bottlenecks, more working capital tied up in transit. Even before shortages show up, the world becomes less efficient. And when the world becomes less efficient, it becomes more expensive. Now here's where people get this wrong. They think this mainly destroys Europe and Asia, while the United States mostly watches from a distance. That is lazy thinking. Yes, the US is more energy resilient than it used to be. Yes, the US is less dependent on direct Middle East imports than some allies. But the US is still deeply connected to the global pricing system. If global oil jumps, US gasoline responds. If shipping costs rise, imported goods get more expensive. If supply chains tighten, inventory planning gets harder. If markets panic, retirement accounts feel it. So what could Americans expect? Higher fuel prices, higher prices for imported goods, pressure on airline costs, trucking costs, and retail margins, more market volatility, more uncertainty around inflation and interest rates, and potentially more federal spending if the U.S. expands naval operations to reopen or secure maritime routes. The U.S. might initially benefit from a flight to safety in financial markets, with capital moving into dollars and treasuries. But that is not the same thing as being unharmed. Household budgets would still feel the squeeze. Europe gets hit harder and faster. Why? Because Europe is highly exposed to Suez Red Sea shipping and is also highly sensitive to imported energy disruptions. A dual closure would mean higher shipping costs from Asia, longer delivery times, industrial pressure, higher fuel and power costs, renewed inflation fears. Europe already learned from the Ukraine energy shock that supply disruptions can slam manufacturing and household confidence at the same time. If Bab el-Mandeb is closed, Europe's consumer goods pipeline gets slower and more expensive. If Hormuz is closed, global oil and LNG markets tighten. So Europe could face both an import logistics shock and an energy shock together. That's a nasty combination. Asia is central to this story because much of the oil and LNG moving through Hormuz is headed there. The IEA notes that about 80% of oil and oil products through Hormuz in 2025 went to Asia, and almost 90% of LNG volumes via Hormuz were also headed to Asian markets. So if Hormuz closes, Asia is not dealing with a side effect. Asia is dealing with the main event. China, India, Japan, South Korea, and other Asian importers would face more expensive energy, competition for alternative supply, potential industrial cost increases, pressure on trade balances, pressure on currencies in some cases. And if Bab el-Mandeb is also closed, then Asia to Europe trade gets slammed too. That means Asia gets hit from both directions. Energy inflows tighten, export routes become more expensive. That can slow factories, squeeze margins, and weaken growth. This is the part most people care about, and they should, because global crises eventually show up in ordinary monthly spending. If both straits closed, households around the world should expect pressure in 5 main areas. First, fuel. Gasoline and diesel prices would likely rise quickly. Second, groceries. Food production and distribution depend on fuel, shipping, fertilizer, packaging, and refrigeration. Third, utilities. In some regions, gas and power prices would be vulnerable. Fourth, consumer goods. Electronics, clothing, appliances, auto parts, and household items could take longer to arrive and cost more. Fifth, investments and borrowing conditions. If inflation returns and markets wobble, that affects portfolios, credit conditions, and interest rate expectations. UNCTAD has already warned that major shipping disruptions can feed through into consumer prices and food prices, especially for vulnerable economies. So the household budget effect is not abstract, it is direct, and it is usually regressive, meaning lower-income households feel it harder because essentials take up more of their spending. Financial markets would not wait for empty shelves. They would move immediately. You could expect oil up shipping and tanker stocks potentially up, airlines down, retailers under pressure, broader equities down on growth fears, gold stronger, safe haven demand for the dollar and government bonds initially stronger. But after the first panic, the real question becomes this: is the shock short enough to absorb or long enough to change economic forecasts? If closures last days, markets may partially rebound. If closures last weeks, inflation expectations rise. If closures last months, central banks face an ugly trade-off between fighting inflation and supporting growth. That is where the real damage begins. Let's make this concrete. Best case, short disruption. Both straits are disrupted briefly, but military and diplomatic action restore partial flows within days. Oil spikes, then pulls back. Shipping costs surge, then cool. Markets wobble, but stabilize. Households feel higher fuel and some product prices, but the shock fades. This is still painful, but it is survivable. Mid-case, weeks to months. Hormuz flows remain severely impaired. Bab el-Mandeb remains unsafe. Shipping reroutes around Africa. Oil stays high. LNG markets tighten. Inflation returns. Europe weakens. Asia slows. The U.S. feels higher household costs and more volatile markets. This becomes a real global growth drag. Worst case, prolonged closure and escalation. Months turn into longer-term fragmentation. Strategic reserves are used aggressively. Military operations expand. Insurance markets remain hostile. Trade blocs harden. Countries seek permanent alternatives to vulnerable routes. This is where the global economy doesn't just slow, it restructures. This is the part that matters most long-term. A dual strait crisis would force governments and corporations to rethink one of the basic assumptions of globalization, that the cheapest route will remain available. If that assumption breaks, companies start diversifying suppliers, holding more inventory, regionalizing production, and accepting lower efficiency for greater resilience. That means higher costs, less just-in-time precision, more redundancy, more localized trade patterns. In plain English, a less efficient world, a more expensive world, a more politically fragmented world. UNCTAD has been blunt that repeated chokepoint disruptions expose the vulnerability of global supply chains and can reshape trade patterns over time. The world economy looks huge, but in reality, it is held together by a surprisingly small number of narrow passages. The Strait of Hormuz, Bab el-Mandeb, Suez, Panama, a few arteries, a few pressure points. And if Hormuz and Bab el-Mandeb closed together, the damage would not stay in the Middle East. It would spread through oil markets, through shipping lanes, through inflation, through financial markets, and eventually through household budgets all over the world. This is what modern fragility looks like. Not always a crash, sometimes a squeeze on energy, a squeeze on trade, a squeeze on prices, a squeeze on ordinary people trying to make the monthly numbers work. Because when choke points fail, distance gets longer, energy gets tighter, goods get pricier, and the whole system gets meaner. This is Wired Wanderer, exploring the forces shaping the future of our world.